All right, let's take a look at shares of Walmart. There you see it, down about a little over 3%. After the company did report its first quarter results, it was just short of sales estimates, slight revenue miss, marking the first since February of 2020. And, of course, the retailer also weighing in, importantly, on the impact of tariffs. Joining us now, Courtney Reagan. She's here at Post 9, and she has Walmart's CFO as well as our guest.
That's right. Thank you very much, David. And I will bring in David Rainey. He is Walmart's CFO. Thank you for joining us on this very busy day. I mean, David, I think it's important to start with that discussion on tariffs. Walmart's foundation is everyday low prices, but because of tariffs, maybe not so low today, not as low as they were yesterday, and perhaps we're looking at higher prices to come. What's Walmart's strategy?
Well, good morning, Courtney. It's good to speak with you. I want to start with, we had a good quarter in what is an otherwise pretty unpredictable and dynamic environment right now. Our goal, though, we're wired to keep prices low for customers. But the level of tariffs that have been proposed is pretty challenging for all retailers, for suppliers, and certainly our concern is that consumers are going to feel some of that. So we're going to keep prices as low as we can for as long as we can for our customers and members.
Can you talk a little bit about the pricing strategy? With a company like Walmart, you have this very broad portfolio of products. And so maybe a product that is getting heavily tariffed may not actually be the one that price increase is taken on. Maybe it's another item. Can you explain how we should think through that?
Sure. What all retailers are going to do is they're going to look at the cost of their merchandise and try to understand the elasticity of demand for that. And so, as an example, if you're selling something that is maybe a discretionary item for $300 and there's a 50 or 100% tariff on that, it's actually going to be priced at a point where it's going to be more challenging to sell the same number of units. And so what some retailers, and certainly we'll do some of this at Walmart, will do is they'll absorb a lot of that cost increase so that they can still flow that product, still be able to sell that. But the level of tariffs, at least that were originally proposed in early April, were more than what retailers can absorb. And so able to manage their margin, they're going to look across all categories of products and look at the elasticity of the demand for those products and maybe change prices on other products that might not have a tariff applied to them.
How do you flex the inventory? I know inventory was up about 4.5% on the quarter, but U.S. comparable store sales were also up 4.5%. So as we sit right now with this 90-day pause on tariff, at least those high levels of tariff rates between the U.S. and China, should you try to bring in more merchandise now? I know lead times are long, so it's a little hard to be flexible. But how do you think about taking advantage of potentially a lower rate tariff situation?
Yeah, well, that's the crystal ball that all retailers wish they had right now, is to try to figure out where tariffs are going to be at what point in time so they can manage their inventory flow. We, importantly, are continuing to flow inventory. We want to have products on shelves for customers and members when they want to buy them. So understanding what that demand is going to be, though, is pretty challenging. We've not seen a period where you've had prices go up this high, this quickly. We're well equipped and experienced in dealing with elasticities or price increases that are going up 2 or 3%, but not 30%. And so understanding by category, by item, what the demand is going to be is really important to making sure that you have the right amount of inventory in the right places at the right time.
Yeah, Mr. Rainey, I mean, you used the word dynamic a number of times here in this interview. I know in the conference call as well, and certainly that seems to be the case. When you say we're going to try and keep prices as low as we can, as long as we can, there seems to be an implication, at least the belief among some of your shareholders, you will take some margin hit there. But what does that mean? Can you give us a little more sense in terms of how you do think about the future when you say low as we can, as long as we can?
Yeah, everyday low prices is what we stand for. So we want to make sure that we're maintaining the appropriate price points and the price gaps to our customers. But we've also seen, David, that during times like this in the past, we tend to gain share. We tend to come out of the other side a stronger company. And so we fully expect that to happen this time as well. And so there might be some areas where we want to play offense, where we want to be more aggressive. We might absorb some of that impact in the short term for the benefit long term.
So you didn't provide second quarter earnings guidance. I know you reiterated long-term guidance. I'm curious, what are you waiting to see where these tariff rates will settle? Are you trying to figure out how much you're going to pass on? How do you plan if the outlook is so murky?
Yeah, there are a few reasons for that, Sarah. So the first is there's a wide range of outcomes just in terms of what could happen with tariffs. And so we're trying to maintain flexibility as we understand what the operating environment is. The second, as I just mentioned to David, is we might want to be more aggressive playing offense, being aggressive on price in certain areas where we think that we can gain share. And thirdly, and this is maybe a little more unique to retailers like Walmart that use the retail method of accounting, but as cost of goods are received at higher prices, those retailers that use that method of accounting have to mark them up, even on the merchandise that they previously bought. And so that has the opportunity or the possibility of actually resulting in outsized gains in that period. And then if you're in a period where you're not selling that merchandise and you need to mark that down, it can have the opposite effect. And so navigating these next couple quarters is really important, and it underscores the importance of getting inventory right so that you're not having these massive swings in earnings. But I'll say this, when we look at the entire year, we feel very equipped to be able to navigate this. We haven't changed our full year guidance on sales or operating income. So we think that we can navigate this and still hit our guidance. But the next couple quarters, given the uncertainty and some of the sharp swings in prices may cause sharper swings in margins and earnings. Keep in mind, just a week ago, we were at 145% tariffs. Now, we're very appreciative of the progress that the administration has made to get them down to this level, but I would say that it's still too high for consumers. We'd like to see them come down more.